Well, Happy New Year. Hope you had a blessed holiday season. And it's time for another Rogers Capital Market Commentary, where we attempt to be the antidote to water cooler wisdom. Well, I've got some good news for you. Are you ready? 2022 is gone. Man, good riddance too, right? We ended the year, month of December, down about 6%, which put us at negative 19 for the year. One of the worst years that we've had since 1980. In fact, the worst that we've seen since the 2008 financial crisis. We were down actually about twice as much during the financial crisis, down 38 in 2008. But tough. And in fact, third worst since 1980, 2002, so that would be the dot-com bubble bursting. 2002, we were down about 23%. So, good riddance, right? I've got some more good news for you. Historically, what follows tough years like we just saw in 2022? That's right. Rebounds. In fact, we saw the two tough bear markets we just discussed, 2008 and 2002. We saw a 23% rebound from 2008 and a 26% rebound following that 2002 dot-com bubble bursting. Now, what will drive that rebound for us as we have our outlook for 2023? Well, softening inflation, the Fed easing off on rates, believe it or not, a recession. We've talked about the National Bureau of Economic Research, but it's interesting that once they finally call it a recession, many economists think maybe first or second quarter, that sometimes that's the all clear and the market begins to anticipate things going higher. But really probably a primary driver, the word we use in investing is capitulation. When folks just finally say, that's it, I'm done. I can't do it anymore. And when that occurs, the big boys come back in. The Wall Streeters come back in. You see, the big boys don't wait for things to feel good again. They don't wait for all the lights to turn green again. If you're waiting for all the lights to turn green between here and town before you head to town, you'll never get to town, right? And in fact, historically, we find that Wall Streeters, the S&P, is generally anticipating by about 6 months. So those are the things that should kind of lead us, hopefully, sometime earlier than later this year. The S&P has bounced back at an average of more than 20% within 12 months of coming out of post-World War II bear markets, and more than 40% following the last 7 bear markets since 1987. Now, is that going to happen tomorrow? No. Is it going to happen 2 weeks from now? No. But once these factors start to play in, and hopefully that's first quarter, second quarter, then we can begin that rebound, like we've seen in rebounds of the past. Near term, we're probably looking at more of what we've been dealing with: volatility, this yo-yo. Good news, hey, things feel great, and then the Fed comes in and things don't feel good anymore. In fact, we've tried this rebound twice last year in 2022, only for it to be snuffed out by economic data, or really the Fed kind of in both instances, snuffing out the optimism with a commitment to higher rates to drive that inflation back to 4% near term, 2% long term. Another little tidbit of good news: rates are starting to pay something again. Money markets and savings are starting to pay something again. In fact, I've just stumbled on here recently, and I'm sure we all will be talking here shortly, first quarter reviews, about a money market paying about 4%, which is crazy after all of this, all these years of savings paying nothing. In fact, I've mentioned this in the past that I'll touch on some things, but this is the Wall Street Journal from when I started in this business in February 2nd of 1998, where short-term interest rates, cash savings, paid over 5%. You say that today, and it doesn't even sound real. It sounds fake. And yet historically, in times like this, and even back during the roaring late 90s, savings paid something, rates paid something. So for some of us who need to allocate to savings, to short term, to bonds, to safer things, a little bit of good news that those are finally starting to pay something. Another thing I kind of want to address here, you may have seen in the news, is the Secure Act 2.0 and the flurry of the omnibus that had to be, of course, our last attempt at pork barreling with another $1 trillion that better get it in before the House changes hands, right? Some important things that came about. Secure Act 2.0. We saw, we'll see now, an increase in the required minimum distribution age to 73 starting in 2023. And a further increase to the age of 75 10 years from now. So they're bumping that required minimum distribution age. Second, we'll see higher catch-up contribution limits for ages 60 and 61 and 62 and 63. Some of you familiar, we're already, once you hit 50, you're able to throw an extra $1,000 in on your IRA contributions, 401k, retirement plan contributions. And so, that's an interesting, a nice addition or change. And then finally, an establishment of a retirement savings lost and found, a national online searchable database that will be established at the Department of Labor, which will enable retirement savers who might have lost track of your pension or your 401k to search the contact information of the plan administrator, maybe find some retirement assets that you'd forgotten about. So think Texas unclaimed property, and hopefully that'll get up and running here before too long. And who knows, maybe you can find $1 million out there with your name on it. Well, again, Happy New Year. Looking forward to a new and improved 2023. We'll talk to you next time.